All right, good morning, or good afternoon, I guess it is. It's good afternoon here in the United States. It is evening in some other places of the world right now. So good afternoon, good evening, good morning, maybe for some other people. But my name is Greg Michalowski, and I'm here today to speak with you about the topic titled "Sifting Through the Trading Clues." Sifting through the trading clues. I hope you find it interesting. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk and may not be suitable for all investors. In addition, that leverage creates additional risk and loss exposure should you decide to trade foreign exchange. Carefully consider your investment objectives, your experience level, and your risk tolerance to lose all or part of your risk capital in the foreign exchange market. So I like to say be aware and be prepared. Who am I? My name is Greg Michalowski. I've been working in the financial markets now for 28 or 29 years. Kind of lose track of it. 15 years in the institutional market as an interest rate trader for Citibank and Credit Suisse First Boston. It took me to London for a stint as well for about four years, and 6 years at Citibank New York, and 5 years at Credit Suisse First Boston. Worked for 13 years with FXDD, and for the last 5 or 6 years I've been more involved with being a trading mentor for FXDD. Now, that is all changing. Increased regulation in New York, all sorts of other stuff is making me look elsewhere. So I'm in the process of leaving FXDD after being there for 13 years, and you will not hear. This is not the last of me. I'll be around, but just letting you guys know that that change is coming. I'm the author of Attacking Currency Trends. www.attackingcurrencytrends is where you can find the book, or on Amazon.com. I've been it's one of the higher ranked foreign exchange trading books. I think last I looked, 4.7 stars out of 5.0. So I'm very proud of that, and been training and talking about mentoring traders now for a number of different years, and part of that process, or part of my everything that I really know about trading foreign exchange and about risk and all that sort of stuff is in that book, Attacking Currency Trends. So if you're interested in purchasing that book, you can always go to my website at attackingcurrencytrends.com and purchase it there. I think it's cheaper than Amazon, and I'll sign it for you. Anyway, what do we have? What kind of markets are we dealing with here today, or not necessarily today, but today as in recent times? And what I've found, and I think most of you agree, that markets are more difficult, in as much as that they haven't been moving that much. The trading ranges are lower. The markets seem to trend less in a range. If you take a look at something like the euro versus US dollar, the range for the year is about 516 pips from the low to the high. Now you compare that to the history of the euro, and you compare it to the most narrow trading range that we have had in the euro going back since its inception in 1999, and that 516 or 18 pips that we're currently trading at for the year. Granted, it's only beginning of June and we still have a long way to go, but around this time you like to compare where we stand in regard to history, and 516 or so pips compares to 1,040, which is the most narrow of trading ranges that we've had in the history of the euro. So we're half of what has been the most narrow trading range. And there are various reasons for that, and I don't really want to go through them necessarily here. We'll save that for another day. But that says to me that markets are a little bit more difficult. It's more difficult to make a few pips. Now, on the other hand, it was easier to lose a lot of pips in more volatile markets. But I approach trading in a positive way, that I'm going to make money, and I'm going to do all my best to stop those losses by defining risk and limiting risk and such things like that. So I look for larger trading ranges. I'm not all that happy with the narrow trading ranges. So you have to adjust, and in adjusting for myself, I want to sift through more clues to try to get better trade location on a day where I could, hopefully become a little bit more precise, if you will, with my trade location. After all, folks, there's not a lot of room for profit in these types of markets. So traders are forced to sift through more clues to try to get a better trade location, and that's going to be my theme here today. I'm going to show you some things that I'm looking at now that maybe I didn't look at or pay attention more to in the past, and hopefully that'll make you a better trader in the process. For those people who don't know me, I see comments saying nice to meet you here in the chat window. But for those of you who do not know me, I have a disciplined way of looking at the market for trading opportunities. Specifically, with no position, I will look for what I call key borderline levels and trade near them. I use the word borderline, it really means support or resistance. But I use a borderline level to get that visual in my mind about bullish above, bearish below. It's kind of like the borderline between New York and New Jersey, and that's where I kind of got it from. When I was a kid, we used to travel to New York, a few times a year from New Jersey, and we'd cross over through one of the tunnels from New Jersey into New York, and there was a borderline there, and it felt like I was going into a new world, into a new place, into a new direction, and that's why I start to use the word borderline level, because it's bullish above and bearish below. So I try to trade near these borderline levels, so because the market tends to move away from them. And so what does that mean? Well, in a visual, in a chart here, and I just put the euro versus US dollar on a daily chart. This could be the euro versus US dollar on a 5-minute chart, which is another time period I look at. It can be an hourly chart, which is another time period that I look at, or the daily chart. Those are the 3 time periods I look at and try to find some clues from each. Not so much that they are that they're short-term, intermediate-term, or longer-term. I just want to find borderlines that different types of traders out there in the market are focused on. So I think longer-term traders are going to focus on the daily chart, or that's going to be a main focus of them. I think intermediate-term traders are going to look at the 1 hour chart. That's my proxy for intermediate-term traders, for the swing traders. And I think intraday traders look at the 5-minute chart. So this, just this example right here, I'm just looking at the daily chart, but it could be the same. I use the same tools in all the charts. So it could be a 5-minute chart, an hourly chart, or a daily chart. So let's look at this, and I want to focus here on the yellow area, and I'm just going to introduce the blue line, which is a 100-day moving average. I'm going to introduce a trend line right here that connects different lows together. I'm going to introduce the green line, which is a 200-day moving average. I'm also going to introduce a Fibonacci retracement. Those are the 3 tools that I use. I'm very disciplined, as I said, in what I look at, and so those are the 3 tools that I use. And so now let's take a look at going back from as far left as I possibly could here, and see what I mean by trading against a borderline. And if we go to point 1 right here, the market was coming down. It was coming near the 100-day moving average. It didn't quite get to it. It got close to it. It wasn't, but if you're an aggressive buyer of the euro, if you're taking the clue from off the low here, you see the correction come down to here, and you see the 100-day moving average here and you want to buy against that. You may be a buyer here, you may be a buyer on this bar when the market doesn't get there and starts to move higher, and you start to benefit from that. So that's what I mean by trading near a borderline level. Now let's go to the top side here and see a different borderline level. Here we have a trend line that connects 2 points right here. And lo and behold, this buyer up here is probably selling up here. Why? Because it's a topside trend line. It's a borderline. It's bullish above and it's bearish below. And as long as he sells against that level right there, what can that trader do, or I do, or you do, or whatever? If you sell against here, if the market goes above this level, you can always buy your position back. So when I trade against a borderline level, I'm just trying to get as close as I can to where a trade can take place without having to risk a lot of my trading capital. And that is what all traders try to do, is preserve that capital as best that they possibly can. Am I saying that you can pick tops and bottoms? Well, if you're patient enough, you actually can. I mean, here's an example where you picked a top there. Why? Because you can define risk and limit risk against that level. You'd be surprised how close you can get to the level. Levels at times, it takes a lot of patience and takes a lot of practice and takes a lot of confidence and all that other stuff. But if you start to just put together what you can see and think that other people can see the same thing, you'll find that you'll be able to buy at 3 or down near 3, near the 100-day moving average again. And you'll find that you may be able to sell at 4 up here. Now, in this case, you sell at 4 up here because it's against this high right here. We also have this topside trend line up above that level. So there are really 2 levels to sell against up here. 1, the high right here. 2, the topside trend line. And so the first attempt, while the market's moving higher off of 3 and makes its way, over a number of days here. But again, this could be an hourly chart, it could be a 5-minute chart. Doesn't matter. You get the same type of patterns here because traders want to trade against levels that they can define the risk and limit the risk. So at level number 4 here, it's the first look, and the market comes down a little bit, just a little bit. And the next day we move above that level. So you may have gotten stopped out on this initial trade right here, but you are still looking. This is still an important level, as is this level up here, and the market doesn't get up there, and the market starts to come down. At some point the market dies, and in this case, this failure up here, when we took out the highs and we only went up by, half the distance between that high and this high right here, we started to lose momentum right here. You can see it in the chart. And where do we go and find support against the 100-day moving average? But then ultimately the market moves below that level, and traders turn from buyers to sellers right here. And so 5 is an opportunity to sell. And where are we today? And over the last week or so, this is the ECB interest rate decision here. So a very fast and volatile market. We actually went through the 38.2% retracement of the move up from the July low to the high, and the market found support against, or market couldn't sell below that level, and led to a move back above the 200. And now over the last couple of days, we're down here testing the 38.2% retracement at the 135.27 level. And we'll take a closer look at that later on in my presentation here. But what I've demonstrated here, what I've shown here is what borderline levels are, and why you as a trader should be cognizant of them and look to trade against them. That's part of sifting the clues for that good trade location that's going to allow you to profit in these types of markets. So test number 1 or clues number one in difficult markets is make sure you're patient and try to figure out the little clues that you can see where you can define risk and limit risk against borderline levels. And you'd be surprised how your trade location gets better and better. All right, so are there other clues that might help your trading? Other clues that are in addition to what we all can see on a chart. And so if those people who have been following me have probably noticed that I'm starting to use I've been putting up this winners and losers, and you'll see it on Twitter as I transition. I'll do this every day, and I'll try to put comments on the Twitter until I get my blog site up and running and stuff like that, which is going to be coming shortly. But the winners and losers of this is of the day provide me with a little bit more information about who's winning and who's losing, which currencies are the strongest and which are the weakest. And specifically what this graph shows is the daily percentage change of one currency versus the other major currencies. For the Canada dollar, that includes a percentage change versus the U.S. dollar, percentage change versus the euro, percentage against the pound, the yen, the Swiss, the Aussie, and the New Zealand. And as you can see from this graph, all the currency pairs, or the major currencies, are down against the Canadian dollar. Putting it another way, the Canadian dollar is stronger against all the major currencies on this day. All right, and this goes back a few days. I'll get to that a little bit. It's not today's date. I was starting to prepare for this a few days ago. So the and the percentage that's shown here is the percentage change for the Canadian dollar against the major currency pairs. All right, so you all with me? All right, and I hope Annette to be able to have this live on my website, my forthcoming website, at some point or another. But if you follow me on Twitter, Greg Mike FX, in the meantime, generally around 8 o'clock or before that time, you'll get a tweet from me that will take a snapshot of the strongest and weakest currencies for the day. All right, you'll see this chart. Okay, so just my Twitter is Greg Mike FX. Just mark that down, follow me, and I'm looking at your Twitter. If you're not a member of Twitter, I suggest that you do become a member of Twitter. There's lots of information there that you can find from that. All right, so let's get back to the chart. So if we were to now focus here on the Canadian dollar, which currency is the Canadian dollar strongest against? And the answer is the Swiss franc. The Canada versus Swiss franc is the strongest of the Canadian for the Canadian dollar versus all the other major currency pairs. So that's information. Okay, is it? Does it tell us a lot? Not a lot yet, but we're gonna get there. Okay, so now I want to take a look at this top bar right here. All right, and this ranks the strongest to the weakest currencies for the day. And the way that I rank it is very simply by adding up all these numbers for each currency pair. So the Canadian gains against the dollar, against the euro, against the sterling, against the yen, blah, 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 they get all added up right here, and it comes out to 2.13%. That's just the cumulative gain. It's not a, if you compare this to, let's say, the dollar index, here it says the U.S. dollar change. This takes all these increases and decreases of the U.S. dollar against the major currency pairs. This isn't an equivalent of the dollar index or a Canadian index or an Aussie dollar index. Those indices, I don't even know if there's a pound sterling index, but if there is, I know there's a dollar index, and the dollar index is weighted. Okay, it's weighted with more weight to the euro, less weight to things like the Swiss franc and New Zealand dollar and Aussie dollar. So that's a weighted currency chain. What I do here in ranking the strongest to the weakest is just equally weight all of them and say, all right, today, which currency is the strongest by looking at the percentage change from yesterday to today. Get with me? Get it? And then you just simply rank it. And I always have the dark green one is the strongest, and the weakest one being the red one. So these colors will change on the day, and it'll change intraday as well. If the U.S. dollar, we have a strong U.S. data come out, and the dollar moves sharply to the upside, you're going to see the dollar move ahead of the Aussie and the pound sterling, maybe even the Canadian dollar. It's going to change along the line. But the point of this is to get a snapshot and understand what we're looking at here. So if you look at the U.S. dollar as an example, it's 0.52 is its cumulative. And the other thing that you should note here is that if there is a gain of the Canadian dollar versus the U.S. dollar, in other words, the U.S. dollar versus the Canadian dollar is going down, so the Canadian dollar moves higher in that respect. If there's a gain of 0.18 for the Canadian dollar, there's a loss of an equal amount on the dollars chart. So if you were to look at, let's say, the euro versus the Canadian dollar, it's minus 0.57. If you look at the euro versus Canadian dollar down here, it's plus 0.57. So all these numbers and all these numbers, if you add them all up, are going to equal to 0. Okay, one gains a certain amount, the other one loses a certain amount, and then you rank them accordingly. So you have access, So this is a piece of information. This is sifting through some information. Does it get me a trade just yet? And the answer is no. All it tells me is that the Canadian dollar is the strongest currency, and the Swiss franc is the weakest currency, and in between we have the other currency pairs in line there according to that chart. So it doesn't give me a trade. It doesn't say just go out and trade these currencies. It does give me incentive to take a closer look, though. And now I'm going to go to a tweet. I put that chart up a few days ago. It was on June 9th, as a matter of fact. And this gentleman, who I blurred out and hid his name, because it's, he didn't really give me permission to use it. But this is an actual tweet, and you can actually go on Twitter. My account will probably find it. But what should I do with the attachment above? In other words, that wins and losses. It's kind of broken English. He's from overseas, of course, but I couldn't speak his language, so I'm not going to deride him for that, certainly. Do you buy the Canadian Swiss? So he's looking at this and saying the Canada versus Swiss franc is the strongest currency right here. Do I go out and buy that? Do I go out and buy that currency pair? And my answer to him is, let's look a little bit closer at the Canadian Swiss chart and see if there's borderline levels. Remember, number one, look for those borderline levels that will give us some confidence in what this chart is saying. So what do we know about this chart? So this is that day, okay? And what do we know about the Canada Swiss, which is which is the strongest currency pair of the day? This is at that time, what do we know about the Canada Swiss? And we know it's a trend day up. That's the first thing that we know. It's a trend day up. The market had some consolidation right here, and then we trended, and it's a trend day up. Why? Because everything's green, 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 and it's going to the upside, and a bigger trading move. This is obviously ECB meeting, but this is just a normal day, okay? This is just a normal Monday, to be honest with you, okay? So it's a trend day up. What else do we know? Well, let's look at the low right here. And what can we deduce at this low right here? There was buying down here. There was buying at 81.48, wasn't there? That's what I see in this chart. Do you see it? Well, we bottomed here. We went up a distance. It wasn't like it went up to, it went up a bit and then came down again, and we found buyers. And then we went up again, almost to this high, or, a little bit above this high. So we're having some trouble, but we're seeing we saw some buyers down here. Remember, we're right here, okay, when we're looking at this. So the gentleman's question is, do I go out and buy Canada Swiss right now? And so we have to make our judgment as far as the market. Now, what else do we know here? Now, let's go to today, okay? This is yesterday and the day before. Let's go to today, this day on June 9th. And what do we see right here? Here's our 100. Remember, the blue line's 100, and now we're looking at an hourly chart here. So they're all the same. All the charts are the same, just different. But the same moving average. What do we do here? We came up to the 100, and then we broke through that level, and we found additional momentum up to. So we broke above the 100-hour moving average. Is that bullish? And the answer is yeah. So you can see why the price is moving higher. What else do? We broke above this trend line, which is 1, 2, 3. Then we had the ECB meeting, which is just messes up your whole charts. But we went above that level and then fell down real quickly to the downside here. And then we came up to that level and we broke above the 38.2 and we broke above the trend line. So you can see how we came up to the line, we came down a little bit, we found support against 38.2 and broke above. So that's bullish too. So we're getting all these bullish clues. Too bad, if you were trading this, not at this point right here when I showed the gains, but right here, you might have been a buyer here, and at that time, maybe that Canada Swiss was also strong at that time, but we're looking up here. So anyway, what else do we know? We know that so we're above the 38.2, we're above the trend line, we're above the 50% retracement level right here at 82.19, so we broke above that. We broke above the 200-hour moving average, which is the green line in the chart, and so we're above that level. What would be the next target? The next target would be up here at 61.8, right? Now, we also know that the range is pretty big for the day. Compare this range with any of these other days right here, apart from this day right here. The range is a pretty decent range. Maybe it compares to this, looks a little bit more than that day, but it's a pretty decent range already. So what do we know from all this? And what we know is the bias is bullish. But just knowing that from the chart that the bias is bullish because of all these reasons, you still have to make a trade and you still have to define your risk. I'm always concerned about defining risk, so you have to define your risk. And so my question is also, where is my risk? And so I will ask myself the following question. At this level right here, given that it's a trend day where we went above the 100, we went above the trend line, we went above the 38, we went above the 200, went above the 50%, we did all these things that are bullish in one day. That's pretty convincing that there's a change going on here. But what I want to ask myself is, that change, what we saw here today, may not last, okay? Because remember, the markets are more difficult now, and it can easily reverse off of this level. So if I'm bullish and I have this idea that I want to buy, I'm still going to ask the question, where do I not want to see the price go below? Where is my stop? And the first level that, or where do I not want to see the price go below? And the first level that, given right here, in answering his question, is the last level that you broke through, or the last levels that you broke through, automatically become a potential support level. All right. If you're targeting getting through this trend line, guess what? When you get through it, it's now a support. If you're targeting to get through the 100-hour moving average, and you go up to here, where do you not want to go back below the 100-bar moving average? So when we get up to here, we get through the 50% and the 200, where do you not want to go below? Well, the 50% retracement level. But the thing about this level and this level right here as a borderline level that we broke through is that this level was relatively early in the trend. This is relatively late in the trend of a big range for the day. So we know that markets get tired. And so they will correct. And so this might be a little bit too close for here. And so what I've done is I put in another line here that may be a proxy for where I don't want the price to go below if I'm going to buy right here. And the reason why I choose this is because it was a high right here and the market went lower. The market bounced off this level, came higher, came lower, and we fell short of it and we started to move down here. So it was a high that kind of stuck out. And it also corresponded with this high right here. The market moved above the 100 bar moving average and or the trend line and the 38.2 and came down a little bit and then rocketed through that level. So that's it. You know, it's just the level that's a little bit lower that, and if I put a Fibonacci on here, it might be near the 38.2, but I didn't have, you know, it looks like it's around the 38.2. So this is probably close support. If I was going to buy right here, if I was going to suggest that this gentleman who asked the question, do I buy Canada Swiss right now? I would say, well, if you buy it right here, you'd probably put your stop right there. Okay. And if I'm really bullish on the Canada Swiss because of all the things that we've done here, that would be a level that I don't want to see the price move below. Okay, so that's my stop, and that's where I define. Now, a more you know, not so close stop might be at 8203. Now, you know, and this is probably the most logical place where your stop would be. If I'm going to buy up in this area right here, I probably have to risk down to the 8203 level, which is the 38.2 and the trend line. That we have two things there, so that kind of solidifies the level. So you're risking about 20 pips on the trade if you were buy at 23 right now and stop is at 02 or something like that, or 02 or 03. So you're risking about 20 pips on the trade. So, but remember, this is a trend-like move. So, you know, you're sifting through the clues. All the clues say trend move. Trend moves tend to move fast, directional tend to move in larger trading ranges than they normally would. So this is the level that you probably, put your stop at. If you were really, really, really conservative and wanted to go to sleep for the next 3 days or something like that, you might look at the 100 bar moving average and say, you know, which is flattening out here and starting to move up a little bit, that you don't want to see the price move below that level. But if the market should go from here all the way down through the 91.89 level, we'd be taking back the 50%. We'd be taking back the 38.2. We'd going back below the trend line. This would more like you know, I would probably get out right here and then look to buy right here if I'm more interested in buying this pair. But I'd be a little bit more cautious if the market came all the way down here. So when I see this, when I sift through clues of what the market is doing by looking at originally, oh, look, the Canada Swiss, a currency pair, by the way, that I don't normally look at. If I sift through that and say, that's the strongest currency today, maybe I want to do a trade in that currency. Where is my risk? Where do I not want to see the price move below? Write that down. Use that sentence. Use that exact words. Where do I not want to see the price go below? Because if it goes below, it's not continuing in the trend. And so you do that, and you become more confident in your trade, and you're sifting through the clues. You're listening to what the market is saying to you. It's saying Canada Swiss is a buy. It's saying there's a lot of buyers in the Canada Swiss, and that's what I want to find. I want to find where there's a lot of buyers in the market. So what happens? We don't go down it at all. You know, in fact, on that day, the market just kind of sideways its way for the rest of the day. Oops. What am I doing? I want to go back. I'm going the wrong way. I'll get there. Hold on. Okay, what did the market do? The market consolidated, and you can see what happened here. It didn't go down, and so as time went by, as we got into the London session the next day, the market did try to go back down, but by this time, the buyers are this isn't going down. We had all the opportunity to go down here after this trend day. It didn't. Market found support against a 200-hour moving average of 50% retracement. The buyers came in. The market moved to the upside, and this is where it's trading at today. So, the lesson is sift through those levels. Now, another thing that you can do in your analysis to sift through at another level. I mentioned that I like to look at not only the hourly chart, but the daily chart and the 5-minute chart. And if you take a look at the daily chart here, what do we see here in the daily chart? This is our day where the market moved higher, and this is what the history looks like. Now, what has the Canada Swiss been doing? It's been trending to the downside. What did we do in the month of May that was different? We got above the 100-day moving average. Unfortunately, I only have this data here, but you can imagine that the blue line over time kind of came around this way. So we've been below the 100-day moving average going back to July of 2013, probably. I'd imagine that the 100-day moving average kind of came around this way, okay? So we got above the 100-day moving average, so what is that, bullish? Yeah, and so the market moved above that level. We came down, we found support against the 38.2, and the market moved higher here. So this is the day that the move occurred. And note here at the low, where did the market find support? Found support against the 38.2 on this day, and the market moved higher off of that day. This is the 47 level where we have the two lows right there. This is a day where the 62, where the low came in at 62, the market moved higher. So off the daily chart, it was showing bullishness as well, and that's good news for traders as well. So it gives you confidence by sifting through not just the hourly chart, what it's saying to you, not just what the change is saying, the fact that it's the strongest currency. Take a look at the daily chart as well and see what that day is saying. See that the market held the 38.2 of this longer-term move to the upside, and that's going to give you more confidence in your trade. You'll be able to sift through and make some sense out of it. Now, another thing that I've been doing really for a while now, but looking at more and more in recent times because of the types of markets that we're in, is I take a look at the current range for the day, and typically I work the New York shift, as most of you know. But I look at the current shift of the current range of the day and compare it to the month average or the 22-day average. If you have a standard month, what do you have? You have 4 weekends, and the standard month is 30 days, and you take 8 days off because of the weekend. 22 days is going to be your average, about your average number of trading days in a month. So I want to get a proxy for what the volatility has done. And look at that and compare it to where the current range is. And so this is today. Okay, this is today. We came in. We had a 38 pip trading range this morning. The average trading range is 61 for the euro. If you take a look at the New Zealand versus U.S. dollar, what do we have last night? We had the interest rate decision in New Zealand, and that has an 165 pip trading range with a 56 average here. So we have two extremes here. One where the market's gone a big move, and one where the current range is a narrow move. So I want to take a look at both these. With that knowledge, I want to take a look at both of these currencies and see if there's any trades with that knowledge. Let me go back here. If the range is 38 pips, all right, the current range is 38 and the average is 22. What do I think about when I see that? And what I think about is that there is a chance that 38 pip trading range might be extended either to the upside or to the downside. Okay, that might be extended to the upside or downside. After all, it's 48, 58. It's 23 pips below what is average. Now it could not do that, or it can extend by 7 pips or 8 pips or 10 pips or 1 pip. But what I look at, or what I sift through and try to figure out, is that, well, we have a narrow trading range in the euro and we have above average trading range in New Zealand. So they're telling me two different things. Maybe this is overbought. Maybe this has room to roam, is what I would like to say. So let's look at the charts now. With that knowledge, let's look at the chart for the euro versus U.S. dollar and see where might the euro extend. What are the clues from the charts of the euro? And let's take a look at the daily chart here in the euro. And if you go back, I don't have it on the chart because I wanted to make it a little bit more clear here, but if you go back to July 2013 low, that's a pretty long way ago, nearly a year ago, and you put a Fibonacci on the daily chart from that low, which is a turning point, up to the high right here, the 38.2 comes into 135.20.7 level. Okay, we looked at that earlier. That's where we're at right in the last few days, is right trading around the 35.20.7 level. All right. What do we know about today? Well, we know the range is low. We know that there's support, or there should be support at 135.2007. The market was below that level, or above that level this morning. Now we went below it, but when New York traders came in, we were back above that level. So the trade is to look for a range extension, either higher or lower. Okay, that's what's in my mindset right now. Now, what else do we know about today is that we had retail sales and initial claims. So there was market risk. I'm going to ignore that. There was a market risk in that data, the retail sales and initial claims. All right. And we're looking at the 5-minute chart right here. Now, what do we know? So normally when there's a lot of risk, like the retail sales or initial claims, I don't necessarily say go out and do a trade, because you're kind of betting, you're betting red or black on that type of trade. So I choose not to do that. But what you can do is get yourself prepared for the next trade. For instance, if we take a look at the day before, and here's our 135.20 level. Remember, that's a 38.2% retracement level from our daily chart right here. Remember that daily chart, 135.20.7. Why do you think there's support yesterday at that level? Because it's a 38.2% retracement. And not only did we see it once, but we saw it twice. We came down to it, we came down to it again, and so this solidifies that level as even a more important level to buy, or that traders are paying attention to. Now, in the London session, we did go below that level. The market should have gone lower here, and it did, but we didn't follow through momentum. And I think the market was a little bit nervous that the price couldn't go below the 20.7 level, so we started to find support there, and the market found support against that level. Now, this is what happened on the retail sales and initial claims data. What did the market do? It went up to the upside first, went up to about 38. We came down to, again, around the 23 level, above the 20.7 level. So let me ask you this. If you know the 20.7 level is a key level, and we've stayed above it here, and we've stayed above it here, and now after the event, after the risk, we're coming down to that level again, you have an opportunity to really focus on and sift through the data and focus on this 20.7 level as an entry level or an entry area. Or you could even buy above the when it goes above the 30 level or above the 31 level, with the knowledge that you think that the price has a potential to extend, and we can't go lower. So which way are we going to extend? Higher. All right. If you can't go lower, which are we going to extend? Higher. It doesn't mean that we're going to go higher. We know that it did go higher, but it doesn't necessarily mean that we're going to go higher. In fact, the market could have come back down and gone through the 20 level. What we do know, however, is that if we bought even at 30, 31, or 32, our stop is below 20. All right. If it goes below 20, out. Get me out. If our sifting through the data is right, and we see that there's support buyers down here at the 20 level, not only today or the last few hours, but also here, we know that there's a potential that the market can go higher. 135.20, yes. Why do you say you can't go lower? You can, okay? It can go lower. That's your stop. So if I said you can't go lower, I'm just saying what I really mean is that you don't want to see it go below that level. All right. So there's a difference. Okay. So what I'm trying to, again, sifting through the data. What do we see here? Low here, another a different low here. We see the break lower here during the London session. It should have gone lower. It didn't. It came back above this level and waited for the retail sales initial claims. And what did the market do? It moved higher from it. Okay, so or it came down to here. It could have gone through that level, but even if you're an aggressive buyer, you're buying against right here against the 20 level at the stop. You can go below the 11 level in that case. If you want to see the low come in place, maybe be a buyer above the 50% of the day's trading range, above the 100 bar moving average. Be a buyer above here, put your stop below 20 level, and say that we should not go below the 20 level. Remember that phrase. Where should the market not go below? If this is going to go higher, if we're going to extend the range to the upside, it should not go below the 20 level. Say that and believe it, and then you have less fear and you go on with it. So we know that the market went to the upside. We came up to and through the high. We went up to the 53 level, and so. It's not a bad, it's not a bad trade, or it's not a bad trade if you were to do that. If you were able to sift through the data, buy even at the 29, 30 level, 31, 32 level, you get 20 pips of a range that's 45 pips or something like that now. All right, I don't know where it is right now. Let me see. The euro's at 46. So the euro's at 46 now. So we want to see the price. Let me go back to the chart. Let me go back to the euro. Yeah, so we came a little bit below the 44 level. This is what the chart looks like right now. So we're just above the 44 level. So it's running out of steam. We extended even further here right away. So that was good news. So we came down to this level right here, which was this low, this high, this low. Came down to there and rocketed to the upside of 65. So made it up to that 65 level, which would have been up here near the 61.8. Anyway, let's get back to the thing. So we went above the 53 level, went up to the 65 level towards the 61.8. Nice trade, not nice or low risk type of trade. Sifting through the data. Understanding that the range is narrow. How to use that data? The range is narrow compared to the average. Look for an extension. If it doesn't happen, what are you going to lose? If we don't get an extension, what are we going to, if we stay in the same narrow trading range, you're not going to lose much. And you have the ability to define your risk and limit risk. So we ended up staying above these levels right here, and that forced the market up to the 65 level, as we just saw on the 5-minute chart. We just came back down to this level here. So the trade's probably over. We went above this level right here, moved higher, and the trade's probably over. So now let's look at the New Zealand versus US dollar, and I'll end with this, and then I'll get to any questions. We'll take a look at the Aussie versus US dollar in kind of the same way. So we know that the New Zealand versus US dollar has the opposite of what the euro had this morning. We had 165 pip trading range. The 22 average is about 56 pips. So we're almost 3 times what is normal. Who was asking about the Aussie? Ivan's asking about the Aussie. Maybe the New Zealand a little bit overbought. So let's do the same routine. Take a look at the daily chart. What do we have in the daily chart? Well, where are we approaching? We're approaching this high at 86.93 level. That's just a corrective high after reaching our high point right here. The market came down. We moved up to a correction level. It looks like about 50% of this moved to the downside and then continued to move to the downside. So that when the market moves in a big trading range, it's always looking for a reason to stop or to stall or to take profit. And that's what we're doing here in the New Zealand versus U.S. dollar. That's what we're approaching here. When each of these levels become more and more difficult to go. Now, in the process, what did we do? Remember, this is very similar to what the Canada Swiss was. We trended to the upside. We went above this trend line right here. We went above the 50%. We went above the 61.8, and now we're coming up to our next target up here. So we're trending higher. Or run into the next resistance here at the top. So we've broken above key resistance. Price is testing the next target of 86.93. Now let's look at the 5-minute chart. And this was, about 2 hours ago where I looked at it. I don't know where it is right now, but what do we see from this 5-minute chart? where might you be interested in trading or sifting through the data here, or thinking in terms of, you might even be thinking in terms of getting out of a New Zealand position because the market is approaching this 93 level up here and finding resistance against that level. You may think about selling the New Zealand versus US dollar because it's near that 93 level. Here's the 93 level up here. What is the 5-minute chart telling us? Is this telling us, what is this telling us about bullish or bearish? And what we know is that there's sellers through here against the 86.93 level. So risk can be defined against that 93 level. We know it's buyers are against. We also know that buyers against the 100-bar moving average on the 5-minute chart. We came down to it right here. We came down to it right here. We came down to it right here. And there is a clearly defined support level here against the 100-bar moving average. When the market consolidates like this, it allows the moving average to catch up, and then the market has a decision to make. But does it want to go higher? Does it want to go lower? And what we're seeing on this chart from looking at the daily chart and also the 5-minute chart is that we have sellers above against the 86.93. We have buyers below against the 100-bar moving average. Who's going to win? Okay, who's going to win? So we're sifting through the data, understanding that the range is wide, and understanding what our support and resistance levels are on the 5-minute chart here. So traders may look to sell against the 93 level, but they need to see the price move below the 100-bar moving average. If it moves above the 93 level, I'm probably out. Because it's a trend day to the upside, I'm probably out. So if you sell against that level, you probably get out if the market moves. But maybe you put your stop at 87 even, because if it gets above there, then all bets are off. But and we're near that big figure level. But I would be very cautious in a trend day to the upside because we're near that level. All right. For buyers, if you're a buyer up here and you're sifting through the data and you are. Now, you're kind of dancing with the devil because you're three times the average trading range right now. But looking at the 5-minute chart, your risk is defined as well. Your risk is defined against a 100-bar moving average. If it moves below the 100-bar moving average, you might expect the price to move down to 38.2 to 50% of the trades level. That's how I look at this market and trade this chart if I were interested in trading the New Zealand versus US dollar. I can define my risk, I can limit my risk, and I can sift through other data, secondary data like ranges and average trading ranges, and compare it and have an understanding that, well, there may be a counter trend trade here, or there may be an opportunity to take some profit if I'm lucky to be long from below right here, and take some profit up here near a resistance level, and go home and play golf or do something like that. That's what I try to do. That's what you should try to do. So in summary here, in more difficult markets, traders need to sift through clues and attempt to get better trade location. Okay, the best trade location that you should always strive to get as good a trade location as you possibly can get. Looking at other things like trading ranges, like which currency pairs are doing well and which currency pairs are not doing well, it might provide an opportunity for you to sift through that data and those charts a little bit more with a little bit more keener eye and look for those opportunities where you want to catch a trend, get on the trend, take advantage of the price movements that you're seeing. Take advantage of the buying or selling that's going on in that market, in that specific cross-currency pair or other currency pair, a currency pair that you may not normally do, in the attempts to try to find those extra pips along the way that these difficult markets force us to go after. In the old days, it used to be easy to catch, to have a 120 pip trade in the euro. All you had to do was catch one of those trends. Not that that was all that easy. But it allowed you a little bit more opportunity. Now you have to be a little bit more of a discerning buyer and make sure that you try to buy at certain levels. Don't try to make it complicated. Just try to make it logical, like I hope I was able to explain here today. And sometimes that logic and simplicity, or oftentimes that logic and simplicity, whether it's trading or anything else in your life, when you define logic, when you have logic and you have simplicity and you focus on risk, you have the opportunity to make the right decisions. All right? So I do it. You can do the same thing. Good fortune in your trading. So let's take a look at the Aussie versus US dollar here. I'll make this a little bigger here. Okay. Well, let's go. I have the good fortune of having this hooked up to today. Today it's a bit distorted. All right. If you take a look at the strongest to the weakest, what is the strongest currency pair? We know it's a New Zealand dollar. What's the weakest currency pair? The Aussie versus U.S. dollar. Or the next strongest is the Aussie versus U.S. dollar. This is distorted. This number right here is distorted a lot by what happened in the New Zealand versus U.S. What happened to the Aussie against the New Zealand dollar, and that happened against a lot of the different currency pairs. So a lot of compared to looking at the other currency pairs, the Aussie is the next strongest currency. It's up against all the major currency pairs, including the U.S. dollar right here. So the Aussie's been strong, and that's what we see off of this chart right here. So we know that there's buying going on in the Aussie versus U.S. dollar. All right. Now, where's my other chart? Let's take a look at the current range of the Aussie versus U.S. dollar. 89 pips versus the average trading range over the last 22 days, 55 pips. So it too is showing strength. It's a good distance above the average trading range. Look at the euro, by the way. We came up to 53. So we didn't quite get to the average trading range here, but we went from 38 to 53. So we increased it by 15 pips off of the high. So that's what that moved to the 60s. So we have an 89 pip trading range now. 55 pip is the average trading range. Now again, toward the end or toward end the afternoon where things start to die down. But let's take a look at the Aussie versus U.S. dollar on a daily chart. And the comment from Ivan is that the Aussie is overbought. And so what do we know about this Aussie versus U.S. dollar? Well, you see this 50% retracement level right here, Ivan. This is of this longer-term move down from the 2013 high down to the 2014 low. All right, and the 50% retracement level comes right there. So that was rock solid. Now that happened. We're just going back in time, reading back in time. So that's rock solid here. And since we came down here this last time, what do we have? Up. A little down today, and up, a big up day here. So we've done the right thing off of this base right here. Okay, off of this base right here. Things started to turn around really right here, and we started to move higher. We got above the 61.8. We got above the trend line right here yesterday. And today it looks like we went back below that trend line. So there was some movement below the 93.61 level, which is a concern. But we'll take a look at the hourly chart and see what that is telling us. What do we know here? We know that the high for the year is coming up at 94.60, and this trend line right here, which connects 1, 2, 3. We went a little bit below it here on looks like this might have been let me see. Yeah, it was unemployment day right here. We went a little bit below it, closed above it here. So that might be a volatility move through that level down to the 50% retracement level, moved higher. So we have a good trend line right here. We broke through it, and now we're coming back to the underside of the trend line. So we know 94.47 is good resistance. 94.60 is the high, and that's going to be good resistance. We know we have a big day to the upside here above the average. What does the hourly chart show us? All right. So again, using the same tools on the downside here, when the market was coming to the downside, I guess there's some Aussie news that came out to force the market down. We went below the 100-bar moving average, but quickly rebounded back to the upside here. And I had this trend line in place yesterday. Actually, I haven't even looked at the Aussie chart today because I'm preparing for this webinar. But I had this trend line in place, and we fell below that line. We also, fell below. This was an old trend line right here. The market moved above and below. But you see this line right here: 1, 2, 3, 4. We fell below that line on whatever news came out this morning, and then we moved back above it. So we failed on the breaks here, and things started to turn around here because there's strong buying off the lows. So when the market moved back above this level right here, back above this trend line, fail below the 100, move back above that. That's why you see this move right here. That's why you see this quick move right here, is because this was a failure. This was a total failure. Market moved higher off of that. Okay? And what have we done? We've moved higher. And this line, you see this line right here? And again, I haven't looked at this chart here today till right now. Yes, it's that's even better. Oops. Anyway, this line right here, I just did a parallel line and just connected to the highs right here. And what do we see here? We see 1, 2, 3, 4. So we have a good channel going on here. Failed below the bottom side of the channel. Came up to the top side, found some sellers, moved above that level. So where do we stand now, Ivan? Where do we stand now on the Aussie versus US dollar? We're above our resistance level here. We're above the resistance level. On the daily chart, we're above our previous high right here, which comes in at 94.08. We know that. We know we have resistance up here at around the 47 level and the 60 level. But until the price starts to move down below this level right here, we know we have an average trading range, which is low, which is more than average, or the trading range is above average. But right now, remember I was saying that if the New Zealand goes higher, I don't want to mess with it because it's a trend day. Right now, the Aussie's showing signs of being a trend day as well. So we want to see the price move back below this level before even though the market may be overbought. I want to see the price move back below this trend line right here and stay below that line. If it moves below here, where's your stop right there? You don't want it to go up. If it moves below here, where do you want to see the price start to move to? Look at here. This is the 5-minute chart. If it moves below this line, where do you want to see? Where would there be next support? Probably right here, right near the 100-bar moving average on the 5-minute chart, which is right here. And this also corresponds with these highs right there. So that's how I see the Aussie. If we get below that level, let's say you sell it on a break here and it starts to go down, and where would you put your stop after the move below this level? You don't want to see it go back above that line. Always ask yourself, where do I not want to see it go back above? And it would be back above what it just came from. All right, and the fact that it's moved above that level, you don't want to see it move back above that level. So things may be overbought, but right now things are more bullish here and we haven't seen a big reason to sell. If you sold here, right here, because we're up against the top side trend line right here, and the range is more wide, I would be stopping myself out through here. I wouldn't mess around with it. I don't mess around with trends and trading against counter trends, or counter trend trades against what is a trend day here. Doesn't mean that I won't sell against here. It just means that if it goes above there, I'm going to take my small loss and I'll look. I may look again for the same trade, but at a different time. All right, does it make sense? There's nothing real bearish about what we're seeing here in the Aussie versus US dollar just yet. The only thing that we know is it's higher, okay? Up here would probably be good resistance up here on the 60 level, as usual, as you'd expect. All right, are there any other questions over my time? Whether I want to thank, probably because at the end of the day in the FX Street, people want to go and enjoy starting World Cup fever here. I want to thank everybody for coming in here today. Again, okay, go ahead, ask me a question. Here's in New Zealand. We're still battling that this battle here. What's the high price? 89. So we still haven't been able to get above. While the euro was going higher. Remember the euro had the narrow trading range. while the euro was going higher, what was the New Zealand doing? You would expect the New Zealand to go higher, but it ran out of steam. So here's the euro moving higher in the New York session right here. What is the New Zealand doing? Nothing. It's just sitting there. It's not. It can't get above the 93 level, but we can't get below the bar here as well. So the polls are still in control. Where's your question? Where's the next book coming out? Thank you very much, Greg, and to all of you. I might have to do that. Thank you. Might have to write a new book, and this might be the basis of it. Is instead of attacking currency trends, trading the longer-term trends in the market, attacking the shorter-term trends in the market by putting the odds of success in your favor. Yeah, just a different slant. I want to thank everybody for coming in here today. Good fortune with your trading, and wishing you all the best. And look for me, folks. Look for me. Okay, I need help. And we'll talk to you later. I use simple moving average. Simple moving average. If your moving averages are different than mine, check with your broker. I use a 5 o'clock closing price. Some brokers close their day at 12 midnight or Greenwich Mean Time or something like that. But the official closing time for any day is 5 p.m. 5 p.m. New York time. You got it. 5 New York. Yep. So there may be little differences because of although the foreign exchange isn't traded on exchange, so there may be. And the other thing is I use the bid side of the market. So if you have a wider bid-offer spread, that might have an impact. Some of the cross-currency pairs might have an impact on where it goes. The bid side of the market is where I use the price. But nice and clean right here in the New Zealand versus U.S. dollar. 93 versus where do we stand right here? 76. Looks like the Canada Swiss. Thank you people at FX Street, and thank you again everyone for coming in here today. Good fortune with your trading. Greg Mike FX. Put that on and attacking currency trends. We'll talk to you later. Bye-bye.